Nothing is easier to trade, psychologically speaking, than high probability strategies, trades that win a lot. In this video, our head of options trading, Seth Freudberg, reveals 3 ways to create options trades with a 70% probability of success, allowing him to win statistically 7 out of 10 trades. I'm Mike Bellafiore, and we're one of the top proprietary trading firms located in New York City and proud to develop numerous 7 and even 8-figure per year traders. Stick around to learn Seth's trading system that all of us can handle.
Hi, I'm Seth Freudberg, and I'm the head trader of SMB Capital's options trading desk here in Manhattan. And one of the frustrations that every day or swing trader faces, and particularly newer, developing traders, is the simple fact that even really solid, successful, talented traders will have a win rate of somewhere between 50 to 60%, which means that, to state the obvious, you have a loss rate of 40 to 50%. And that's for successful traders. Most traders will have a win rate that doesn't even crack 50%. And frankly, that can be demoralizing for many traders. And so that's why we decided to do a video about a trading style that has a much higher win rate than most other trading styles. And that trading approach is known as options income trading. And it's a style we use very frequently on our trade desk here at SMB. And in this video, we're going to be going over 3 strategies that have a statistical win rate of at least 70%, and you'll find out how that's possible in just a minute. If you're new to options trading and you don't know much about options and how they work, we've created a video for you to understand options basics. And if you click the video appearing on your screen right now, it will lay the groundwork for understanding the strategy we're going to be teaching you in this video. Then when you're finished, you can come back and watch the rest of this video if you want. The first strategy that we're going to be covering is known as the credit spread. And this strategy is very easy to learn, so let's jump right into an example. So let's head back to a price chart of the S&P 500 index, the SPX index for 2022. And as you can see, after selling off all year in October, there was a powerful bounce around that 3,500 level, and the market successfully held that level for the rest of the year. And so suppose that immediately after the new year, you decided to enter the following trade when the index was trading at 3860. So you pulled up an options chain that expires in a month on February 2nd, and you went ahead and sold 5 of those 3575 put options on the SPX index, and simultaneously you bought 5 options at the 3550 strike for protection. Well, when you do that, selling a put with a higher strike price and buying a put with a lower strike price on the same options chain, expiring on the same day, when you do that, you have entered into what options traders refer to as a put credit spread. Why do we say that this trade has at least a 70% probability of profit? But let's take another look at that options chain. And as you can see, there's a column called delta. And if you look at the delta of the 3575 puts we sold, you can see that it is 12.6. Now, it would take a while to explain exactly what a delta is, but for now, suffice it to say that it measures how much an option's price will move based on the movement of the index that the option is derived from. And so it turns out that statistically, the delta of a put option can tell you the approximate chance of that option expiring with no value. And you'll see in a minute why that's so important. And that's because if you subtract any put options delta from 100, you'll get a statistical approximation of that option's chances of expiring worthless when it expires. We're going to come back to that idea in a minute, but before we do that, let's break down the cash flow of this transaction so you're clear on how this trade works. And so when you sold that 3575 put, you got a price of 1810. But you might recall that index put options pay off at a rate of $100 per point below the strike price on the day it expires. And so you multiply that by 100 and you sold 5 of them. So when you multiply it all together, you'll receive $9,050 for those 3575 puts. But then you turn right around and buy 5 of the 3550s for $15.35 for protection. So using the same calculation, you pay out $7,675 for those protective puts, resulting in net positive cash flow of $1,375, which your broker will deposit into your account immediately. Incidentally, your broker is going to require you to have $11,125 in capital in your account to enter this trade, which is the trade's worst case scenario loss. Okay, so now let's move to the day this trade expires. And as you can see, on that day, the index had bounced as anticipated, and the index closed at 4179.78 on that day. And so now the options have expired, we can now value them. So let's take a look at that. And in fact, that's going to be a pretty easy exercise because, as you can see, both put options expire with zero value because the only way they pay off is if the index closes below their strike prices. But in this case, the market closed more than 500 points higher, up at 4179.78. And so both the 35.75 puts we sold and the 35.50 puts we bought both expired worthless, resulting in us simply pocketing the initial cash flow of $1,375 as pure profit because neither of the options had any value on expiration day, and that constitutes a 12.35% return in a month. And this trade can be done repeatedly throughout the year, and using that same delta, the trade would have a statistical chance of working out over 80% of the time, as we explained earlier. Now let's move on to our next strategy with a higher than 70% probability of profit, and that is a strategy known as the Iron Condor. And the Iron Condor is a strategy you'll use when you think that the market is likely to stay in a range during the time period of the trade. And so let's pick up right where we left off on February 2nd, where the market had bounced in January, and you felt that perhaps the market needs to digest that move a little bit. And so you feel like over the next few months, the market might be more range bound. And so suppose on that day, February 2nd, after you wrapped up that first put credit spread trade, you decided to put on a trade that is appropriate for a range bound market. And so you pull up an options chain expiring in mid-March, the March 17th options chain, and you went ahead and did something similar as before. In other words, you sold a put credit spread where the 5 short puts were around 12 deltas down at 38.25, more than 300 points below where the market's trading, while simultaneously again buying 5 puts 25 points lower than that at the 3800 strike. But this time he does something else, which is he heads up to the 45.50 strike on the call side, and he sells 5 of those. And as you can see, the delta on those is 11.2, so almost 12 on that side as well. And he also simultaneously buys 5 of the 44.75s for protection. And so what he's done on the call side is to create what options traders refer to as a call credit spread, where you sell a short call at a lower price and then buy a long call at a higher price. And so when a trader does that, forming a put credit spread below the market and a call credit spread above the market, when a trader does that, he forms what options traders refer to as an iron condor. And when you calculate the probability of profit of an iron condor, you do a similar calculation as we did with the put credit spread, but this time you subtract the delta of the short puts you sold, which in this case is 12.56, but you also subtract out the delta of the short calls you sold up at 44.50, which in this case is 11.20. And as you can see from the calculation, it results in a probability of profit of 76.24% in this case. And you'll see why in a minute, why that makes sense, and why this trade makes sense if you feel the market is going to be range bound. Okay, so again, let's look at the cash flow of the iron condor that we've entered here. And as you can see, just like before, we sell the puts at 21.70, and with the 5 that we sold, we collect 10,850. But then we turn around and pay out 98.50 for the protective puts, and then moving to the call side, we sell the 44.50s for $5,525 while buying the 44.75s for 43.50. So when you net it all down, it results in a cash deposit into our account in the amount of $2,175, which would require at least $10,325 in capital in your account for your broker to permit you to make this trade. Okay, so let's move forward now to March 17th, the day the options expire. And as you can see, the index actually sold off over 250 points from its price when we entered the trade, but it nonetheless remained in the general range that the market had traded in since the fourth quarter of the previous year. And so let's now calculate the final value of the options comprising our iron condor, because on the day options expire, you can assign them a final value. So we'll start by remembering that we had initially received $2,175 when we first entered the trade, but after that, it's a pretty straightforward exercise, because as you can see, with the market closing above both put strike prices, both the long and the short puts, as well as the market closing below both the short and long calls, with that happening, and the fact that puts pay off only if the index closes below their strike prices, and calls only pay off if the index closes above their strike prices, because of all that, all four options expired worthless, which means, again, that we just pocket the cash flow that we received at the initiation of the trade. And so that cash flow equals our profit, meaning that the $2,175 we got at the outset of the trade becomes our profit, which is a nice 21% return in 45 days, which is not too shabby. And one more important point here, and that is that as long as the index had closed at any price between the highest put strike and the lowest call strike, in other words, anywhere between 38.25 on the downside or 44.50 on the upside, anywhere in that 625 point range would have earned the same $2,175 profit, because all four options expire worthless anywhere in that 625 point range. And so that's why iron condors are the right strategy to use if you think you have an idea of the range an index will trade in. A third great way to set up a 70% probability win trade is to pick the right location to sell a cash secured put. Okay, so what is a cash secured put? Well, let's give you an example and it'll become really clear. Let's take a look at Adobe stock, which trades under the ticker ADBE. And as you can see, Adobe was trading in the same range for several months leading up to the middle of January, with pretty consistent support at 320. And as you can see, it closed at 342.53 on January 19th. And so suppose on that day, January 19th, you pulled up an options chain expiring about 2 months later on March 17th, and you went ahead and sold a put right at support at 320, which, as you can see, has a delta of 28.65. And the price you'll receive for that put is $10.20. And so because that put gives the put buyer the right to sell you 100 shares of Adobe, you multiply that by 100, resulting in cash income of $1,020 to you. But I'd like you to focus on something we kind of glossed over earlier, which is that the delta of that put is 28.65, meaning that the approximate probability that the 320 put will expire worthless is 71.35%, as you can see, much higher than the probability of a day trade working out, because as we discussed before, 100 minus an options delta is approximately its chances of expiring with no value by the time it expires. And so if we move forward to March 17th, the day this option expired, we can see that Adobe continued to channel over the next few months, closing at 358.14. And so by now, you probably realize what that means for our trade, and that is that the initial cash flow we received, that $1,020, becomes our profit because the put option expires worthless, with Adobe having traded up to 358.14, which is way above our 320 put strike price. And one word of caution here is that you should never sell a put at a price that you're not more than happy to own the shares. And that's because had Adobe closed lower than 320, you would have been obligated, of course, to buy the shares at 320, no matter how low Adobe was actually trading on expiration day. Having said that, as of today, Adobe's trading actually at 550, and so had you gotten assigned the shares, that would have actually been a very good thing in the long run, right? So what I'd like you to take away from today's video is that there are multiple ways to set up options trades with 70 to 80% statistical probabilities, whether you're talking about the 87.4% chance of that SPX put credit spread working out, or the 76.24% chance of that SPX Iron Condor profiting, or the 71.35% chance of that Adobe cash secured put making money. Each of these strategies in their own ways are benefiting from the statistical nature of options trading and the fact that the farther out you go from the current price, selling the options at those more distant strike prices becomes a highly probable win, which most traders find to be psychologically satisfying and will increase your confidence as you grow in your trading career.
So you're an active trader, not doing as well as you want, not doing as well as you deserve, and you just can't figure out why you can't become profitable no matter how hard you try. Well, let me show you why. This is your competition. The traders in this room. This room right here is full of elite traders, some of whom are making 7 and even 8 figures a year. In fact, our top guys have made nearly 20 million each in net trading profits in a single year. Let's head to my office so I can share more. So you're probably used to seeing videos of lavish trader lifestyles, trading gurus trading off of a laptop for an hour a day, heck, maybe even 15 minutes a day, and then them relaxing on some secluded beach for the rest of the day. Well, all I can tell you is that our traders train like pro athletes. They live and breathe the markets and are continually working on their trading skills. Because at our firm, that's what we found it really takes to make it in this game. I'm Mike Bellafiore, co-founder and managing partner of SMB Capital, one of the world's top proprietary trading firms located in Midtown Manhattan. And we're always looking for trading talent to hire and develop. And not just to trade in-house on our desk, but also to trade from their own home, entirely using our firm's capital. And we have numerous traders doing just that, allowing them to make upwards of 7 figures trading the firm's capital without risking their own money. But to even get a shot at something like that, you need to have the right training. That's why we're doing a new free online presentation in which we share how you can get an interview with SMB to become an in-house or remote trader, trading firm capital without risking yours and gaining access to all of our firm's coaching and resources. And the best part, you don't have to be a profitable trader yet. In fact, we prefer to mold profitable traders with our methods and our techniques. That's why we have just 3 simple criteria that can earn anyone an interview. We're looking for highly ambitious and determined traders who fit our culture first and foremost. So if you believe that could be you, sign up for the free 1-hour online presentation by clicking the link that's in your top right corner of your screen now.